Picture a casino. But every single table in this casino is connected by the same wire. You lose big at blackjack, and somehow that loss forces the guy at the roulette table 3 rooms away to also lose his chips, even though he never touched your cards. That sounds impossible in a real casino, but it is exactly how a leveraged stock market behaves, and South Korea just spent the last few weeks proving it in front of the entire world. In April of 2025, Korea's stock market, the Kospi, started climbing, and it did not stop. By June of 2026, it had gained nearly 300%. That was the strongest bull run the index had seen since the 1980s. Then, in about 25 trading days, it gave back roughly a third of its value. It crashed so fast that traders in Seoul are now just calling it the wall. Circuit breakers tripped 7 separate times in a single year. On one afternoon alone, the index fell close to 9%. SK Hynix dropped over 15% in a single session, its worst day on record. Samsung fell more than 10% right alongside it. Hundreds of thousands of trading accounts got hit with margin calls. Tens of thousands were wiped out completely. And government data shows the people getting crushed the hardest were investors in their 20s and 30s. Here's the part that should actually worry you if you live in the US. This wasn't really a story about Korea. It was a stress test, run in fast forward, on a financial habit the United States has been building for years. And the results of that test just came back. So let's actually understand the mechanism first, because the market crashed doesn't tell you anything useful. What matters is why crashes like this can feed on themselves. When you buy stock using your own cash, a bad day costs you money. But it stops there. When you buy stock using borrowed money, a bad day can cost you your entire position. Because your broker has a rule. If the value of your collateral drops below a certain line, you either add more cash immediately or they sell your shares for you automatically. At whatever price the market is offering in that moment, nobody asks your permission. Nobody waits for a better price. The system just executes. Now stretch that across hundreds of thousands of accounts. All of them bought the same handful of stocks with the same borrowed money at roughly the same time. When prices dip, a wave of accounts hits their trigger line simultaneously. Brokers dump shares to cover the loans. That pushes prices down further, which drags a second wave of accounts across their trigger line, which causes even more forced selling. It's not a metaphorical death spiral. It's a mechanical one, coded into the plumbing of margin lending itself. And Korea had built the perfect conditions for that plumbing to fail spectacularly. Here's a number that should stop you. 2 companies, Samsung and SK Hynix, made up roughly 60% of the entire Korean stock index at the peak. Not the top 10 companies. 2. For comparison, in the US, the 10 biggest companies in the S&P 500 make up around 36% of that entire index. And financial commentators already call that dangerously concentrated. Korea had more than half its national stock market riding on 2 semiconductor companies. When those 2 stocks caught a cold, the entire country's retirement savings caught pneumonia. Why would an entire nation build so much of its wealth around 2 stocks? This is where the human story matters more than the spreadsheet. In Korea, there's a well-understood life script. Get a good job, buy an apartment, get married, start a family, roughly in that order by a certain age. But Seoul's housing prices have climbed so far out of reach for younger workers. For a huge portion of that generation, buying an apartment quietly became mathematically impossible on a normal salary. So people looked for another ladder. And the stock market, especially 2 globally dominant chip companies riding the AI wave, looked like the fastest one available. Think about what that actually means for a moment. An entire generation looked at the traditional path to wealth, decided it was closed, and picked the stock market as the only door still open. That's not reckless gambling in the way we usually imagine it. It's a rational response to an irrational housing market, just executed with irrational amounts of leverage. Regulators didn't slow this down either. They added fuel. In May of this year, Korean exchanges approved leveraged exchange-traded funds tied directly to Samsung and SK Hynix, funds that amplify daily moves by 2 or 3 times. If the stock goes up 5%, you're up 10 or 15%. Feels incredible on the way up. On the way down, a single bad session in a 3x fund can wipe out 30% of your position before lunch. And these funds have to rebalance daily, which means on the worst days, the funds themselves are forced to sell into the panic just to maintain their leverage ratio, adding institutional selling on top of retail selling, on top of margin call selling, 3 separate selling pressures, all triggered by the same falling price, all feeding each other in the same hour. Let's slow down on that mechanic for a second, because it's the part most people get wrong. A leveraged ETF doesn't just multiply your returns on the way up and your losses on the way down in a simple, linear way. It has to rebalance its exposure every single trading day to keep delivering that same multiple tomorrow. On a day the underlying stock drops hard, the fund actually has to sell more of that stock right into the falling price, just to reset its leverage ratio for the next session. In a calm market, that's a rounding error. In a market already crashing, it's gasoline poured directly onto the fire at the worst possible moment, by design, not by accident. This is one reason regulators in multiple countries have historically warned that these products are meant for short-term trading, not long-term holding. But warnings printed in a prospectus rarely stop a saver who feels like they're running out of time. Now here's the twist that connects this back to you, wherever you're watching this from. Korea's whole boom was never really a Korea story. It was an American AI story wearing a Korean stock ticker. Samsung and SK Hynix don't just make ordinary chips. They make the high bandwidth memory chips that sit next to every advanced AI processor, feeding it data fast enough to keep up. When American tech giants pour hundreds of billions of dollars into AI infrastructure, a huge slice of that spending doesn't stay in America. It flows straight into orders placed with Korean memory manufacturers. So when American chip demand looked infinite, Korean stocks looked infinite too. And 14 million Korean retail investors, sometimes nicknamed ants, leaned into that story with borrowed money. They're called ants because individually they're small, but collectively they move markets. Then, in late June, one specific event started cracking the foundation. Growing nervousness ahead of earnings from Micron, America's largest memory chip maker. Micron is also a direct competitor to the two Korean giants. When Micron-related chip stocks in the US wobbled, Korean chip stocks didn't just wobble, they convulsed. Because Korea's market had no diversification left to absorb the shock. One country's earnings jitters became another country's national financial emergency, almost overnight. That is the real lesson buried inside this crash. And it's bigger than Samsung or SK Hynix. It's this. When a market's fate is tied to a single story, and that market is loaded with borrowed money, so you don't need bad news to trigger a collapse. You just need slightly less good news than everyone assumed. History actually keeps handing us this exact lesson, dressed up in different costumes. Back in 2000, Coca-Cola quietly trimmed a routine equipment order with Cisco, cutting router purchases from around 10,000 units down to about 2,000. That single decision, multiplied across dozens of similar corporate customers doing the same thing, helped tip Cisco's earnings over, and Cisco was one of the most important suppliers of the entire dot-com boom. The Nasdaq went on to lose roughly 3/4 of its value in the unwind that followed. Nobody rang a bell. Nobody announced, "The bubble is popping today." One large customer just quietly ordered less than expected, and the story investors had been telling themselves stopped adding up. That's usually how these things end, not with a dramatic villain, but with a spreadsheet somewhere showing slightly weaker demand than the forecast assumed. Now let's turn the camera toward home, because the numbers here are not comforting. As of mid-2026, U.S. investor margin debt relative to the size of the entire economy sits at roughly 4.5 to 4.7% of GDP, according to FINRA data. That is the highest reading ever recorded. Higher than right before the dot-com collapse in 2000. Higher than the run-up to the 2008 financial crisis. Higher than the meme stock mania of 2021. Total margin debt in dollar terms has been setting fresh records nearly every single month this year, climbing past $1.5 trillion. And that official number is almost certainly an undercount, because it only tracks traditional brokerage margin loans. It doesn't capture leveraged ETFs, it doesn't capture options exposure, it doesn't capture portfolio margin arrangements, or private credit used to fund stock positions. The visible iceberg tip is already at an all-time high. Nobody knows exactly how big the part underwater is. Meanwhile, American investor cash cushions are shrinking in the opposite direction. Net credit balances, meaning cash sitting in accounts minus debt owed, have fallen to a record negative reading, deeper underwater than at any point on record. In plain English, as a country, American retail investors collectively owe more against their portfolios than they hold in reserve cash. That is precisely the setup that turns an ordinary market dip into a forced selling cascade. There's also a quieter warning sign sitting right next to the leverage numbers, and it's easy to miss if you're only watching daily price charts. This year, newly listed companies have come to market representing more than 12% of GDP in combined post-IPO valuation. The previous record for that measure was set at the very peak of the dot-com bubble at roughly 5%. In other words, companies and their early investors are cashing out into public markets at more than double the intensity of 1999. Historically, a flood of IPOs like that tends to show up exactly when insiders believe valuations have peaked, not when they believe there's much more room left to run. It doesn't prove anything on its own, but paired with record leverage in a market this concentrated, it's not a coincidence you want to just wave away. And just like Korea, American markets are also riding heavily on one narrative: artificial intelligence. A small handful of companies, the chip makers, the cloud giants, the AI infrastructure builders, account for an outsized chunk of total stock market value. And their earnings increasingly depend on each other's continued spending, in a closed loop. One company's AI capital expenditure becomes another company's AI revenue, which becomes a third company's justification for even more capital expenditure. It's a beautifully self-reinforcing story. Right up until the moment, spending growth merely slows down, not stops, just slows. And the whole loop has to explain itself to nervous investors. Some respected market analysts have pointed out something important. The return on every incremental AI dollar spent by major tech companies has already been declining over the past year, even while total AI spending keeps climbing. That is the exact pattern that historically precedes a repricing. Not a slowdown in spending yet, just a slowdown in the payoff from that spending. Think about the position that puts company leadership in. At some point, an executive at one of these companies has to stand in front of shareholders and defend spending tens of billions of dollars on infrastructure that's earning less on every additional dollar than it did the year before. For a while, the market rewards the spending itself, treating bigger capital expenditure numbers as proof of confidence in the future. But that dynamic tends to flip eventually. Investors start rewarding restraint instead, applauding the first company brave enough to say, "We're pulling back." And once one major player says that out loud on an earnings call in front of analysts, the entire chain reacts because everyone downstream was pricing in that, spending continuing at the same pace forever. That's the moment worth watching for, more than any single price chart. So where does that leave you, the person watching this and wondering if any of it actually matters for your own money? Here's the honest answer. Leverage itself isn't evil, and AI infrastructure spending isn't fake. Real memory chips are genuinely being installed in real data centers, processing real workloads right now. The danger was never the technology. It was the financing structure wrapped around the technology, borrowed money stacked on top of a narrow, concentrated bet with almost no cash cushion left if the story pauses even briefly. Korea gave the world a live demonstration of what happens when that structure meets a moment of doubt. The United States is currently running a larger, slower motion version of the exact same experiment, with a bigger economy, a deeper pool of capital, and so far, more room to absorb a shock. But the core vulnerability, high leverage riding on a narrow, unproven story, is not fundamentally different. So what can an ordinary investor actually do with all of this instead of just feeling anxious about it? Start with the simplest question. How much of your own portfolio is sitting on borrowed money right now, whether that's margin debt, a leveraged fund, or options exposure you might not think of as leverage but functions exactly like it? If the honest answer is zero, a lot of this risk simply doesn't apply to you personally, even while it applies to the market you're invested in. If the answer is not zero, this is the moment to understand exactly where your own margin call threshold sits before the market decides to test it for you. Second, look at concentration, not just in your own portfolio, but in the index funds you assume are diversified. A fund that tracks the whole market can still be quietly dominated by 5 or 6 companies riding the exact same narrative. That's not a reason to sell everything and hide in cash. It's a reason to know what you actually own. Instead of assuming a fund name like Total Market automatically means safety through diversification. Third, keep an actual cash cushion, separate from anything invested, sized for your own life, not for a forecast about the market. Cash isn't a bet on the market falling. It's what lets you avoid becoming a forced seller if it does. None of this requires predicting the exact week a downturn happens, which nobody can reliably do anyway. It just requires making sure that if a downturn happens, you're not the one getting margin called at 2 a.m. with no say in the matter. If you take one thing from Korea's crash, let it be this. Watch the cushion, not just the price. A market can keep climbing for a long time on borrowed conviction. What determines whether a pullback stays a pullback or turns into a cascade is how much unborrowed cash is sitting behind it when the pullback begins. Right now in the US, that cushion is thinner than it has ever been on record. That doesn't guarantee a crash tomorrow or next month or even this year. But it does mean the floor is lower than most people watching their portfolios today probably realize. Markets have survived concentrated bets before, and they've survived heavy leverage before, just usually not both at the same time, at record levels, simultaneously. Korea just showed the entire world what that combination looks like when it finally lets go. And when the ants start moving, as Korea just proved, they can move a lot faster than anyone expects. The only real question left is whether the US market is watching Korea as a warning or simply as a preview of its own coming attractions.